to do is do a 1250 call that is extremely deep in the money. Sorry for the interruption, but this is a 1250 call. So back in the beginning of 2011, one of the things that I want to point out here is that first I'm going to show you how they made the move here. This was the 2011 pullback in this 1250 call at the time. This was back on 1/10 of 2011, okay? And we were, at that time, the low was $43 a contract. So we went from $43 a contract all the way up to $93 here. What a great move for the bulls and for lots of people. And we're overbought. We're imbalanced, meaning that they don't stay up here. They will come back down. Kind of like something like over here. They don't stay up here. They come back down. This is going to come back down in value. We're inflated in the price here. And it's a deep in the money call that these market makers in the pit can sell short, just like a stock. And when they fall in value, they make a lot of money. And on the very other hand, when we take a look at how devalued or deflated in value means that the low was $345 a contract. Back over here on 1/28 of 2011, these contracts on the high were $23.50. They've taken $20 almost a premium out of these contracts. It's well below the market because that's 90 points below the S&P 500. S&P 500 closed at 1343. So let's take a look at the closing bell of the S&P 500. Hold on one second. What I would like to point out is that the S&P 500 is right here, and it closed at 1343. Okay? Now, this call is deep in the money, meaning that it's a 1250 strike. This call is below the market, out of the money, we call it, way below the market. But as I showed in video 1 here, that the open interest on the 1250 put option is 214,000 contracts. They're already doing their thing. And the 1250 call, on the other hand, that's ran its course over the last several weeks, there's 172,000 of them, and people were still buying them in the money. There's a big imbalance here. People got huge bets that were going down, and what I want you to know, there's the closing price of the S&P. This is the deflated bottom, and that's the inflated top. When the S&P starts to make its normal correction, these come down, these go up. So if you take a look, $93 versus $3. Both 1250 put, 1250 call. It's always been, in my experience level and trading level as a market maker, is that I'm always selling that and buying this. This won't stay up here, folks. So that means inevitably the correction of the S&P 500 is around the corner, because the call and the put side is a helpful instrument to understand where the weekly and the monthly overbought zones on the S&P 500 index itself is, because if we're so overbought, that's how that got there. And this premium here is down, and we can go a little bit lower and we can pop a little bit higher here. The thing about it is, this is the side of the trade that has, this is way below the market. No one's thinking about it. They're all bullish and they're getting great value. What's going to happen is, over the next month, when everyone thinks that the S&P 500 should be rallying, what we're going to see, that the upside premium, you get premium here, but you're not going to get near the premium to the upside here, as this side will lose a bigger ratio on the call because it's so deep in the money that when we do correct, these are coming down. These are going to go up, but not nearly as much as these come down, is what I'm trying to get at, MMTs. And it's a great place to be for a hedge and a short against this trade here of the inflated versus the deflated S&P 500 1250 put March.